Remind everyone that the presentation today may include forward-looking statements that could cause actual results in the future to differ from our expectations. We do encourage you to read the published quarterly results alongside the last set of audited financial statements, which is for the year ended August 2025, as well as the management discussion and analysis that we have published. All of these documents can be located on the Jamaica Stock Exchange website, as well as on the investor relations section of SYGNUS Group's website, which is www.sygnusgroup.com. So I'll now go ahead and introduce our presenters for today's session. So we have our Chief Investment Officer and Executive Vice President of SYGNUS Capital, Mr. Jason Morris. And we also have our Senior Development Project Manager at SYGNUS Capital, Ms. Janelle Worthing. Following the remarks from Jason and Janelle, we will be taking questions. So as usual, we're encouraging our attendees to participate in the session today by submitting questions using the Q&A feature in the Teams platform. So at this time, I will hand over to Jason to get things started.
Thank you, Justine. Good morning, everyone. First of all, let me start out by saying condolences to all the football fans whose side has exited the World Cup. And for those who remain, congratulations, right? Starting off with the major achievements, there's 4 things we want to highlight very quickly. The first one is Kingston Industrial Park, which we would have been presenting on over the last couple of quarters. Construction would have advanced to approximately 20%. And just a reminder that this is now SRF's largest development project to date, representing $4 billion in logistics and commercial hub in Kingston, St. Catherine. And I'll leave the more detailed comments to Janelle, who will provide additional details on how this project is going, etc., later on in the presentation. Second item is One Belmont. Of course, would have indicated to shareholders that we have been working. Well, 2 set of things going on with One Belmont. One is advancing the partial exit or exit of SRF from One Belmont, utilizing a structure that will allow institutional and retail investors to get to own a piece of the building. So that is advancing. We are also would have been completing works for tenants who are on the building but haven't moved in as yet. So John will also give an update on that later on in the presentation. So everything going according to plan there. In terms of deployment and exits, new commitments would have been 433.58 million. And we had exits at 280.49 million so far for the first 9 months of the financial year. And finally, in terms of value creation, since inception, we would have increased the paid-in capital or the equity capital that shareholders would have put into the company by 1.83 times. And this includes both the dividend that would have paid plus the unrealized value in the book value per share that's being carried on the balance sheet. Now jumping into the performance highlights. For the 3rd quarter, net profit would have jumped to 444.29 million versus 151.74 million. And there was one single large main driver of this, and that is that Kingston Development had a favorable gain of 806.9 million recorded during the period. Typically, SRF does valuation at the end of the financial year. However, based on the fact that construction had started on Kingston And once the construction started, because these are going to be lots that are being subdivided to be exited, then the accounting treatment for lake spend changed, and with that change, we had to do a valuation of the asset as at the date of effective commencement. And so that occurred during the quarter, which obviously because of the construction being started, the value would have increased. And so there's a one-time recognition of that value, which is carried through the income statement. So going forward, this value won't change until we're actually exiting at the end of the project. So there won't be any more favorable gains coming through due to the change in the accounting treatment for the expense. I want to highlight that. Total investment income as a result of course, the lake spend asset would have been 675.53 million versus 380.54 million. Net investment income 511.71 million versus 265.29 million for the similar quarter last year. Earnings per share was $1.28 versus 0.44 Jamaican cents, $0.44 and 44 cents in Q3 last year. Book value per share would have increased to $26.67 versus $24.14 for the similar period last year. We spoke about total value paid in capital already in the earlier slide, but from a ROE perspective, SRF is now generating 17.47% since inception to the end of the last financial year, which is August 2025. From a 9 months perspective, the net profit would have been slightly positive, 46.08 million, versus net loss of 45.71 million for the same 9 month period last year. And again, just to recenter everybody, typically due to SRF's lumpy nature, normally what we would have is the quarterly financials being negative and then the year end being positive when the valuations are done. This time around, pretty much the largest driver of value is due to one of the valuations that was done during Q3, which won't recur at the end of Q4. Total investment income was 540.11 million versus 407.13 million for the 9 months period the previous year, and the net investment income slightly down, 84 million versus 105.08 million. EPS was positive 13 cents versus negative 14 cents for the similar period last year. And of course, book value per share will not change because that's as at the reporting date financial metric. Now, there are some items I want to highlight. I will go through all the information on this slide. We want to highlight a couple of things. The first one is net interest income. As you can see, for the 3-month period, even though interest income went up, interest expense was higher relative to last year. And that's because of the more significant use of debt to fund transactions. The net interest income was negative 114.13 million versus negative 83.74 million for this quarter last year. However, for the 9-month period, net interest income was negative 277 versus 299, and that's because of benefits that would have been accrued during the other 2 quarters of the financial year. You can see the gain on investment property at 806.93 million for the quarter and for the 9 months. And then you can see that in terms of joint ventures, there wasn't a lot of movement. We registered a small loss, 34.8 million for the 3 months and 52 million for the 9 months. Of course, normally what happens at the end, financial year end, is when the the valuation on those normally take place. What else? Fair value gain or loss on the financial statements, negative 30.3 million versus smaller loss versus loss of 55.4 million the similar quarter last year. But for the 9 months, it's 100, loss of 110 million versus 108. And these are really being triggered by the fair value that SRF has in third-party real estate investment notes that's carrying on the balance sheet. Of course, FX for the quarter is negative, for the 9 months is positive. And that's primarily reflecting movement in the Jamaican currency relative to the US currency on the primarily on the liability side of the balance sheet. So borrowings that SRF is doing in USD. So the coins that appreciate or depreciate, it results in a loss in appreciation, depreciation. Well, appreciation again and depreciation a loss because it's USD and SRF postage, which we don't have control over. What I would say though is that if you recall, I've had many discussions on this, that SRF's SRF's real estate assets are actually denominated in USD. So the real FX exposure is actually embedded in the value of the assets. But that value isn't really broken out as an FX line and a real estate gain line. It's at the end of the financial year, you get one value. So the exchange rate moves in one direction. The liability side may show a bigger FX loss, but the asset side would show a gain, but the FX gain is broken out. So if you read the audited financial statements, you'll get the clarity to what I'm saying regarding it. So I just want to create clarity there. All right, moving on to the balance sheet. Shareholders' equity was up to 9.26 billion versus 8.38 billion for the similar period last year, and total assets now amounted to 18.14 billion, up 12.9% versus 16.06 billion for the similar period last year. You can see the trajectory in what the shareholder paid in capital is, 5.1 billion, and that the total shareholder value now is 9.33 billion. And this, of course, includes a 65.7 million in dividend that was paid the previous year. So that's how we get the 1.83 times total value to paid in capital, which is a way to look at whether or not value is being created to shareholders. Of course, our job is to ensure that we exit the assets and crystallize cash and use that cash to pay dividends or make special distributions to shareholders, which is what we're hard at work trying to do in terms of trying to wrap up one by one exit. Of course, we have some third-party liens that we are working to work out. We have the lake spend projects we expect to conclude sometime next year, etc. Moving on to the next slide in terms of how the company is being managed. We would have given a commitment to investors to ensure that management expense ratio remains below a 3.5% target threshold. And we have done that, continue to do that. But also, and this is very important because effectively we want to ensure that every dollar of expense is optimized so that we have that extra cash to reinvest in the business or, as appropriate, use that to pay out dividends. So if this ratio gets too high above the threshold, then that's defeating the process. They can see that we have been very consistent pretty much since SRF became a publicly listed company. Moving on to investment activity. The total real estate investment assets on the balance sheet, 17.65 billion, related to 15.7 billion at the end of Q3 last year. And this is comprised of 11.82 billion in total property investment, which is up from 9.62 billion for the similar period last year. Third-party real estate investment notes, 1.88 billion, down 2.24 billion, reflecting some exit. And then from a joint venture perspective, this was 3.96 billion, marginally higher than 3.84 billion for the similar period last year. And in terms of exits, 280 million in the quarter versus 2.05 billion. Well, during the 9-month period, at the end of the 9-month period, versus 2.05 billion for the similar period last year. Investment allocation hasn't changed all that materially. The key chart here is really on the right hand side, investment property, which is 64.4%. That figure is a pretty substantial figure, but we expect that that figure will fall substantially once we start to exit some of the investments that we have, or monetize them, which is what we are hard at work doing every day. Now we move on to the major projects and key strategic assets, which I will turn over to Janelle.
Thank you, Jason. Good morning, everyone. So going through the summary of key strategic assets, starting with the one that's highlighted here, which is our Lake Spain project in St. Catherine. This is our next flagship project, our flagship industrial project. Next slide, please, as I'll go into more details. All right, so we have our Lake Spain Industrial Park project situated in St. Catherine. And as Jason would have mentioned, we're approximately 20% progress on ground regarding construction. We have China Harbor Engineering Company who is actively meeting our schedule, which is on target, and they'll continue to make progress there. Simultaneously, the sale process is also underway. And as mentioned, this would have been the major or first major project in the second investment cycle. Also noted on this slide is our website, which is lakespainindustrialpark.com. I do encourage everyone to visit the website where you'll be able to get more information about the development on whole and the amenities. It also shows, has a live map, which also shows what lots are available. Next slide, please. So I'll go into a few of the key features of this development, which differentiates us from other offerings in the market. Of importance is our underground electrical system. And why is this important? Thinking resilience in mind when it comes to development where we need to head. We have an underground infrastructure for electricity, which means that in the event of a major storm, this disruption to this property or to this development would be at a minimal. One of the major challenges after a major storm or hurricane is the turnaround time to reinstall or to get infrastructure back up and running. So with our infrastructure being underground, then it mitigates against that risk or that issue. Also, security, another key factor for development. So we have 55.4 acres here under development. And for the entirety of that 55.4 acres, we will have a perimeter wall, an 8-foot boundary wall with anti-climb spikes on top. We'll have a checkpoint armed response on site as well. So we've designed this development with security in mind. So whomever our purchases are, whether they're building a cold storage facility, distribution center, light manufacturing, whatever it is, they can do so at Lake Spain Industrial Park with security in mind. Next slide, please. So here we have the subdivision layout, as well as at the bottom of the page, it shows our main project partners here. As mentioned earlier, China Harbor Engineering Company is our contractor on site. And so the subdivision here we will have worked with our project team is well laid out in terms of planning, access, exit points. We have 55 acres with 34 lots available, ranging from 0.8 acres to 3 acres. And as mentioned, the sales process is currently underway. We're between reservations and under offers, we're approximately at 33%. So I do encourage investors to reach out to our realtor partner Catalyst to get going there. Next slide, please. So we had our groundbreaking in December 2025. So the next few slides will just show some photos from that groundbreaking ceremony, which was quite a success. We have the Honorable Dr. Andrew Holness, our Prime Minister, present. We also had Honorable Arvin Hill present, the Minister of Industry, Investment, Commerce. So this photo here shows the attendants or invited guests along with our project team partners and founders. Next slide, please. Just more photos here from the event. On the left, some members of our project team, and on the right, the groundbreaking ceremony persons there. So we have the Prime Minister again, as well as members from the project team and China Harbor Engineering. Next slide, please. Moving on to Miami Bay, another flagship project for us, our flagship hospitality project. This project is making good progress, as you can appreciate. Larger hospitality developments do take considerable planning, investment, and time. Notwithstanding that, we are comforted where we are in this process. And not before long, we will be coming back to you, our investors, to share those plans on how it is that we intend to unlock value in this property here. And just a quick word about the location. As you can recall, Miami Bay is one of our beachfront properties. The location is prime location along the corridor in St. Anne. And this development is situated amongst major hotels. And so we are in fact doing the due diligence necessary to ensure that we unlock value with this property. Next slide, please. So moving on to Delphin, which would be our second beachfront property located in Newport, Trelawney. And this has prime real estate in Trelawney with white sand beach. The location as well is also a good location as it's among other major hotels. There is Rio, there is Ocean Coral. It's also minutes away from the Sangsters International Airport. And so we're also doing the necessary due diligence and planning for this location to ensure we unlock value with this asset. Next slide. Finally, One Belmont. As you can recall, this project, we're at 100% completion, really Belmont. And this would have been our prime commercial development, where we built a cold shell with amenities with 5 leasable floors available to 4 tenants. To date, the third tenant has started their moving in process, and we're making steady progress where that's concerned. So over the next few weeks, they'll be ramping up activities to move in and occupy the space there. This brings me to the end of the presentation regarding those key assets, and I'll hand over back to Jason. Thank you.
Thank you, Janelle, for that excellent summary. Okay, so now just moving into the final slide, which is the update on strategic initiatives. There are 4 key main pillars here. The first one is just to continue executing on our key strategic initiatives. Already went through Lake Spend, that's at 20% completion, and our target time is to complete that maybe by third quarter next year. One Belmont, John already spoke about the tenancy, where we expect to hand over the completed build-out works for that tenant to then make preparations to start moving in very shortly. And I already spoke about SRF exit, which we expect to occur sometime during the 2026 calendar year. Miami Bay value creation process continues. We would have had advanced discussions with interested partners from overseas recently. So we continue to do a lot of work on that. It's a large project. It's going to be one of our next major initiatives. So we have to take the time to ensure that we plan appropriately. And so this is not a rush asset. We're taking our time to be very strategic about how we actually create. We continue to do look for opportunities to do co-developments and to fund third-party investment projects via REINs. Portfolio realignment, we are at 64% equity currently, and we expect that percentage to continue to drop as the portfolio is rebalanced, moving from assets from equity, which is the majority of the portfolio now, to majority income, to flip the balance closer to 70-30 in terms of income generating versus equity type investment. So that process continues. Asset workouts, of course, we have 2 REINs in recovery and workout. And we are working through the process. We think that we have figured out a way to resolve 2 of them. We continue to work with selective partners to work on these, to exit. It's a very slow process whenever you enter into a recovery process. Good thing is that the asset is there and it can't move. So, as we get more update on those, we'll provide them. With regards to footprint in other Caribbean countries, we continue to evaluate several opportunities, but at the present moment, our focus is the 2 big strategic initiatives need to be completed first, right? Or be substantially advanced, which is the lake spend, get that, across the finish line, and then One Belmont, get that exit launch. So in other words, to launch the actual exit investment. So it effectively is going to be an investment for investors, right? That's how we're going to monetize it. So to get that launch. So once those 2 things are far advanced, then we can see how we will make good of opportunities that we're seeing all over the rest of the Caribbean. Dry powder, this is a continuous cycle. You need to harvest and redeploy, exit and recycle capital. And we use a variety of mechanisms, credit lines, construction financing, raise private capital via private markets, etc. So that process is a continuous process, and we continue to do that. And then last, but by absolutely no means least, is the timing of the next dividend payment, which we're not in a position to do that at the current moment, simply because our exits are a bit behind. So once we catch up on that, then we'll be in a better position to have the cash to deploy into dividends versus redeploying the cash into projects that we now have that actually need the cash. So that's the end of the presentation. Can open the floor to take questions.
All right, thank you, Jason and Janelle. So as Jason mentioned, we're going to move into the question segment. So I'll start off with the lake spend questions. So the first one is in relation to the target completion date. What is the target completion date for lake spend, and are there any risks that you're currently managing that could delay completion?
The Lakeside development is an 18-month project. So by summer of 2027, we're looking to close out or to complete construction there. As it relates to risks that we're managing, risk management is an ongoing process as we execute reconstruction on site. So that's an ongoing process. Currently, we don't have any critical risk, which puts the project at a potential for delay or any challenges there. But we continue to assess the risks as we move forward with this project.
Thanks, Janelle. All right, so the next question is in relation to 16 Montrose Road property. Can you provide an update on the plans for 16 Montrose?
I guess I'll take that. Thanks for that question, Justine. Regarding 16 Montrose, we're actively planning and exploring what we're doing here with this project. We do have a plan in place and it's quite advanced. However, as we haven't executed those agreements yet, I would defer any comments on 16-month rules just yet. Once consummated, then we will in fact get back to our investors to outlay the details of that plan.
All right, thanks for that, Janelle. All right, so next question is in relation to One Belmont. And this one is for Jason. Can you provide an update on the One Belmont exit? Is SRF planning to retain any interest in the asset?
The answer to that is yes. SRF is planning to retain some interest. The amount, the amount of interest, it depends on a number of different factors, right? Including how much demand there is for the investment that we have in front of some investors now. Because the way we are structuring this is we are first getting some anchor investors in, which typically would be pension funds, institutional investors. And once we have those agreements locked, then we pretty much, and by the way, the way our SRF was structured is that you had some pension funds who, based on the size of their investment in SRF, they would have received anchor investor rights. And this anchor investor status that they have would provide them with ability to get the first shot at participating in any finished asset that SRF owns, that SRF wants to exit. They would basically have to make a presentation to them to show them what the exit strategy is and allow them the opportunity to consider and get approval to be an investor / owner in that finished product, which is what effectively we have done with One Belmont, right? So we are basically wrapping up or concluding that quote unquote roadshow with those investors. Once that is signed and sealed, then that will then represent the opportunity for us to then open it up to more investors once these anchor investors have had an opportunity to consider and get approval from the investment committee or otherwise to participate. So that process is well advanced. Of course, once we are done with that process, then we will open that up. So I expect that to fully take place in another couple of months tops. I hope I've answered the question.
Thanks, Jason. All right, so the next question is in relation to the new REINs. With respect to new REINs, what sectors will SRF focus on increasing exposure to? I guess, Jason, you could perhaps take that one.
I mean, to be honest, we are agnostic, right? Because we invest across multiple sectors. So the idea here is not so much the sector as to whether or not the project is a good project and we have the appropriate risk management controls, monitoring, etc. in place, and the developer has a good enough track record to manage risk exposures, right? Because construction risk is always a challenging prospect for developers, especially if you're a new developer. So that's the way we are looking at it, right? We are seeing commercial projects that people we have in the pipeline. Of course, there are always going to be residential projects because this is Jamaica, and Jamaica's residential footprint is quite large, but there's still a lot of demand in some segments. Other segments, in my opinion, there may be so a little bit of oversupply. But generally speaking, if you look at real estate as a long-term asset, You look at the history of Jamaica, pretty much is a solid asset to own. The only question is what the yield you can generate on it, and how do you mitigate against construction risk. So those are the things that we're busy trying to assess and evaluate, so that once we have that solid foundation, we can execute. But we have projects looking at, right? Yeah, we have projects looking at in our sector.
Thanks, Jason. All right, and the next question is in relation to consolidated cash. With SRF's consolidated cash being relatively low, does SRF anticipate raising new financing to prepare for any new projects?
But the answer to that is we're always raising cash. I need cash, to have cash on hand to fund projects. But the way we do that is we try to get the cash very close to the time when we need to do deployment. Because as I would have shown on one of the slides, right? Net interest expense is quite high relative to net interest income. Therefore, we don't want to be too advanced in going locking in cash, and then the interest expense bites, and it takes a while for the interest income to come in, and therefore you have a negative carry. Obviously, in the case of putting cash into equity transactions, right? Equity investments don't give you cash until the end of the project. So that just sucks cash until you get to the end, then you get back your cash, assuming that you complete the project on time, on schedule, and within budget, right? So it's even more important to ensure that for those type of projects, we time the raising of capital appropriately. So at the moment, yes, the cash balance is low, but we have multiple plans in place to and have multiple discussions that are ongoing, that are scheduled to be timed with when we need to utilize cash to deploy, versus having the cash sitting on the balance sheet and having a negative carry. I hope I've answered the question from that person.
Thanks, Jason. Believe you have. All right, so the next question is in relation to the second investment life cycle. Will Miami Bay and Lakes Bend be the main projects for the second cycle, and are there any other projects that SRF is looking to acquire in short order?
Well, let me start with the last part first. I wouldn't say that we're looking to acquire any projects at the moment, because our number one, number two, and number three job is to execute on the key strategic initiatives. And Lakes Bend is top of the pile. It's advancing beautifully. Of course, the job there is to ensure that we get 100% sales. So we are aggressively marketing and pushing and encouraging people who want to have an asset in the industrial corridor that is gonna have all the infrastructure that you need. You don't have to worry about it. You don't have to go and get it. If a hurricane comes, there's flooding, etc. We have all of that sorted out. So we are encouraging all of those who are looking for that type of turnkey asset. Visit our website, call our team, etc. We have to execute that. And then, of course, One Belmont, we need to get back our capital. So we need to exit, partially exit the asset, monetize the asset, right? Asset has great tenancy, occupancy. It's a beautiful building. The lease contracts are all multiple years, hard currency linked. So that's a beautiful asset we need to monetize, get back cash. And then obviously Miami Bay to unlock that value. Now, in terms of the timing of Miami Bay, we are scheduling it for obviously investment cycle, second investment cycle, which we are at the beginning of. But as I said before, to get to the final hurdle, that's gonna take a while, just based on what we are trying to do with the asset. We do have a couple other projects which generally would have gone through, right? but they are not major. They are, I would call them minor projects. So as those come on stream, we'll obviously have a lot more to offer in terms of speaking about them. But the major ones are really the Expand, the Exeter One Belmont, and obviously the start of Mama Bay. Those are the three key things. We will, as opportunities arise, we will obviously have a lot of REIN transactions. So as we go through, there will be a lot of REINs that we will be putting on the balance sheet, right? But those aren't going to be, in terms of magnitude, they are not going to rival the Lake Spen, etc. Right? But in total, our objective, perhaps at the end of the second investment cycle, is to have these large project exits far in advance, and then at the same time, the REIN book is ramping up substantially, where the percentage of REINs relative to the percentage of equity type investments, the balance would have shifted.
Thanks, Jason. We have one last question in relation to Surreal. There are primary units currently for sale at Surreal at Sugar Mill. Are these sale proceeds expected to repay SRF's investment? Jason, you
Absolutely.
could take that one.
Absolutely. We put money in the ground, we need to get money back out of the ground. So, simple answer to that is yes. And that is what has been happening.
Okay, so we've gone through the questions. So we are now at the end of our earnings call. We want to extend a huge thank you to everyone who attended our session today. As a reminder, we're encouraging you to read the published quarterly results alongside the last set of audited financial statements, which would be for the year ended August 2025, and also the management discussion and analysis that we published for the quarter ending May. Just a reminder, the documents can be located on the Jamaica Stock Exchange website, as well as on the SYGNUS Group's website in the Investor Relations section. So that's www.sygnusgroup.com. And lastly, a recording of this earnings call and a copy of the presentation will be available later today on the SYGNUS Group website in the Investor Relations section. Thank you so much for joining. Have a good day.